Well, good morning, everyone, and thank you for joining us this morning for the CattleFax Market Outlook. As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with our presenter today, either using the chat feature at the bottom of your screen. If you're on a computer, it's going to say chat, and if you're joining us from a mobile device, it will have three dots on the bottom of your screen that you can select chat and chat in those questions. Before we begin, I'd like to introduce our expert on the call today. We have Mary, who's an analyst with CattleFax. Within her role, she watches the industry trends and serves as a speaker at many conferences and works with Farm Credit Mid-America to make sure that you all have the most up-to-date information available to you regarding the cattle and livestock industry. As a reminder, this webinar is intended for informational purposes only and not for public or media consumption, and any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. So with that, Mary, go ahead and take it away. I'll monitor questions, and I appreciate being here with us this morning.
Okay, yeah, thanks, Micah. Like Micah said, I'm Mary with CattleFax, and I'm excited to give you guys a market outlook. And please let me know if you have any questions when we follow up or within the chat box. But to get going here, we're going to look at where we're at with the weather, because that's going to have a huge impact as we look at hay and grain throughout the next year, and then, of course, pastures. So you can see that we've really gotten right back into quite a bit of drought here. We did have an El Nino to start out this year, which typically means a wetter pattern for most of the U.S. And so that did recover most areas, but we've quickly slipped back into this. We did have a pretty good moisture event within the last couple of weeks, but still generally more of a dry pattern. And we just had our long-term weather analyst in town, and he confirmed that we are probably looking at more of an La Nina pattern as we do look ahead through this winter and then on into next year. And then he's using a lot of what this NOAA data would be using, which is again, showing that we're in more of a La Nina pattern now. He does expect more of a weak La Nina pattern, so not as strong as maybe we were in a couple years ago, but it is typical that we see these last for more than a year or two. So odds would favor that we might be in a drier pattern for longer. And I know for many of you, we never fully got out of that dry pattern, but so this is, of course, something just to keep in mind as we do move forward and look. I mean, a lot of profitable factors would be saying to expand, and that's certainly something to be looking at. But you're going to have to navigate drought, is what the latest forecasts are indicating. And so we've been able to do that the last several years, but just probably more of that. But what we are looking at this year is a lot more corn available than what we saw going into 21, 22, 23. So our stocks to use has grown. We're looking at record large production is what the USDA is indicating right now. And so corn prices should be pretty range bound here at this 425 average, 425 a bushel average. Of course, there can be some pretty big swings, but generally we're looking at a 13% stocks to use. Here, whenever prices got elevated like this, we were looking at less than 10%, more like an 8% stocks to use. So now we do have more of a supply of corn built up, and that should keep prices more range bound and lower. Looking at hay, you can see, of course, during the driest period there, we did get up to extremely elevated hay prices, and there was a lot of volatility there. We've come down a lot, but you can see we're not down to those levels that we saw maybe back in 2016, 17, 18. I don't really think that we'll get back down to that, but we have built up a more comfortable stock position for the hay as well. So when prices got elevated like this, we were at the tightest stocks for hay supplies in 50 years. So going forward, we are in a little bit more comfortable of a stock position for hay supply, but even still, there will still be a lot of dry area, not as good of pasture conditions. So hay demand is going to be good, and that's going to keep prices a little bit more elevated around this 180 to 200 a ton for this alfalfa hay. And then other hay, again, not dropping back down to that 120 range, but still lower than what we saw throughout 2023 and 2022. Okay, so looking at cattle, the cattle cycle and then the supply situation. So ultimately, big picture, I like to show this one first. It's kind of our sustainability slide. So you can see cattle inventories have really been on a downward trend since the 70s. And so during that, or since then though, we've been able to maintain a pretty strong beef production level. Even, I mean, there are some ebbs and flows, but still generally an upward trend here. And so that's really been by maximizing efficiency, whether that be at the cow-calf level or then at the feed yard level with larger weights, less death loss in that. So overall, the cattle industry has kept the sustainable pattern of keeping that beef production strong, even though we are dealing with a smaller cattle inventory. The cattle cycle, just kind of real quick, if we spend too much time here, I can talk in circles around it, but big picture, the cattle cycle tends to move in 10 to 12-year cycles. A lot of that being that it just takes so much time biologically to build the cow herd back up. And so typically you see the cow inventories reach their lows about a year or two before we actually see the harvest numbers down to their lows. So where we're at today is we're probably at the low to the cattle inventory here, but it'll be a couple of years before we see the low in the fed cattle harvest. And then prices tend to peak about a year before we actually see the low in production, because the markets are anticipatory and they do anticipate those prices going high or the supplies moving higher. But one thing about the cycle is, so here's the last 4 cycles that we've had. Just kind of big picture, we're not going to spend a ton of time here, but something important to note is that last cycle, we've got a lot of recency bias as we think about the cattle cycle, where we saw that huge price high, but then the prices moved back lower so rapidly. And if you look, the supply low came in 15 and the price high, that was in 14. So it was ahead of the schedule, but then in 16, there was such a rapid rebuild that prices moved a lot lower. But if we look at previous cycles, which is more what we think this cycle is going to be trending like, we tend to see the supply low, so the cow herd low comes, and then the supply low is a year later, but then the rebuild is a lot slower. So here you can see that over 1 million cattle came back in 2016. We don't expect to see the fed supply grow that big or that quickly either, or the beef cow inventory. So that's a key difference here as we think about this cycle. Here in previous cycles, you can see the beef cow inventory was a lot slower to step up. And what that's done is it's allowed prices to stay elevated for longer. So you might see the price high early, but then prices did remain elevated for years after that as well, as the supplies did take some time to build up. So why is this cycle different than the last cycle? Is that we're seeing a slower rebuild. Supplies aren't going to just surge back like we did see last time. And then at the same time, competing protein supplies are more adequate this time. And then packing capacity, that's a more comfortable position for now. Of course, if there were to be a packing plant that shut down, that would change things. But up to this point, packing capacity, there is plenty of that for right now. And then we are seeing near record beef demand. So there's a lot of dollars in the system, and that keeps prices higher all the way throughout the system. So as we look, like I said, going into 2025, we do expect this to be the low for the beef cow inventory. So we hadn't seen a lot of retention up to this point, and that's still been pretty slow to pick up. But we do expect there to be enough heifers kept back at this point that we can see a slight increase in 2026 and then continued growth in 2027. One thing to note here, though, is that even though we do expect expansion, with all the factors going into agriculture, just an aging producer, fewer operations, and then less land available, we don't expect to see the peak for the beef cow inventory get back up above this 31 million. So we are likely looking at a smaller peak, but we do expect to start to expand the herd here beyond 2025. And then part of that beyond heifer retention is being tighter or smaller culling uh, and then smaller beef cow slaughter. So culling has slowed significantly. You can see we're running well below that 5-year average, well below where we were the last 2 years, but we still wouldn't say that we're at a real expansion pace, more of a stabilization pace at this point. But as we look ahead at our forecast, we're on pace to be down 970,000 head this year, and then an additional 350,000 head the next year. So smaller cow slaughter for years to come, just out of the fact that the herd is smaller to begin with. And we are going to be looking to stabilize the herd, everyone that can in general. But like I said, we have been slow to retain heifers. You can see 2024 that beef replacement heifers was the smallest it's been going back to at least 1990. So the drought's been a big part of that. Drought and then cost of money as well is a big deal with the higher interest rates, and it's just harder to keep back a bunch of heifers at this point. But we are starting to see that. We're seeing a few fewer heifers come to town, and a few fewer heifers being placed on feed. So that is leading to more replacement heifers as we look at those 2025 numbers and then beyond. And then same with the dairy replacement heifers. This has been interesting with the addition of beef on dairy. That's a lot of the reason that we see replacement heifers down so much from these years, because they don't have to breed as many of their dairy cows back to dairy. They can breed them to that beef sire and then get that beef on dairy cross animal. But dairies are extremely profitable right now, and so that would say that they will want to be keeping back some heifers, diverting a few more to be bred back to dairy to add back to their herd. So big thing there, though, is that even as they do look to expand or stabilize, we're looking at hundreds of thousands of differences here. So we've really been in about 100,000 cow range here for the inventory in general the last several years. So even as we do expect some growth, that is a much smaller scale than what we look at within the beef cow inventories. But as we do think about this dairy side of things, they have been able to add a little bit more to the fed cattle supply. So as you look, this chart is showing just the dairy influence. It's an estimated dairy influenced fed slaughter. So up until the last 10 years or so, it was purebred dairy, and it was like Holstein steers. But here in the last few years, and especially lately, we've had a lot more of this fed beef on dairy cross. And that's not only taken out of this Holstein or this full dairy supply, but it's also added to the supply in general without that dairy cow herd growing. And part of that is less veal slaughter. Part of that is also that these are worth so much more whenever they do go to sell them, even at a day old, that I think that they're receiving a little bit more medical treatment and care that's able to keep them to go into that fed system. So as we look, they are adding a little bit to the supply, but still it's about 1 million rather than the multiple million that we've lost in the beef cow inventories. So what we're looking at with calf crop is that if we expect to see the low here for the cow supply in 2025, that should also be when we see this low for the calf crop, but then expect some growth after that. So that's been trending lower. We're off about 3 million from what we were up here. but we do expect to start to grow those supplies back in 2026 and then continue on that in 2027. So that puts the fed supply here down at the lows probably in 2026. So this year we've actually been able to maintain slaughter levels near even with year ago levels. So we're only on track to be down about 75,000 head. Part of that has been we did come into the year carrying some cattle. Part of that is adding those beef on dairy or those dairy influenced animals into the fed supply. And then part of that's been imports from Mexico and Canada. But as we look moving forward next year, we're really going to struggle to keep, we're not going to be able to keep the slaughter level quite as strong just because there's just a smaller herd and a smaller calf crop to pull from. And we're really maximizing it as it is. And then whenever you consider diverting a few more heifers back into being retained and going back into the herd, that takes a few more out of it. So looking to be down about 700,000 head next year, and then an additional 600,000 head the following year. So all in all, from the cycle peak here in 2022, or the production peak, to where we expect the lows to be, we're looking at a 2.5 million head decline. And as you can see, between 2022 and 2023, we already saw 1 million head decline. So just about another 1.5 million head decline from there. But one thing we have been able to do, like I said, is continue to maximize the beef production with the supply. So you can see this year we're on track to be up more than 20 pounds for this cold carcass weights. Something important to consider here is this cold carcass weights is taking an average of the fed supply and the non-fed, so there being fewer cows and then also more steers in the mix, so a higher percentage steer is going to be part of the reason that we do continue to see that increase. And then the other part of that is we've been using a feed additive in the feed industry, Experior. The use of that has grown in steers especially, but here lately, just within the last month, it got approved to be used on heifers as well, alongside MGA. So they're able to use MGA and then feed them the feed additive Experior, which tends to help them gain weight towards the end of their time at the feed yard. So that's been part of the reason for the increase, but then of course part of that is just the change in the mix of slaughter as we look ahead. But all in all, with the 700,000 head decline and then the increase to weights that we expect to see next year, that would still have production down about 2.5%. Now, important to note here, for this year, we're hardly down at all with the increase to weights plus slaughter not being down as much this year. But expect about a 2% decline for production the next couple of years, even with that increased weight that we're expecting. And then if we look from the peak that we saw in 2022 to where we expect to be in 2026, so production lows, we're expecting a 3.6 billion pound decline there. But one thing that we have been able to do is pull in a lot more beef from the imports. So with that, well, we actually end up with more beef as we look at this year compared to last, because of this only being down about 0.3%, and then this increase to imports. So exports, they're actually on track to be down just a bit this year, but at the same time, imports are up nearly 1 million or 1 billion pounds here. But important to note here is what we're importing and what we're exporting is vastly different. So we're importing a lot of the lean trim, a lot from Brazil and Australia. And what we're exporting is, besides hides and offal products, it's also the higher value beef. So just think the choice and above to other countries. So that we have grown demand for that, and that's going to keep exports at pretty strong levels despite the smaller production is the expectation there. So exports are still moving lower, but considering the smaller production, they've held pretty steady. At the same time, we've pulled more imports into our markets with our higher prices and then lack of our lean trim due to the lack of non-fed slaughter. So expect that to continue, but growth there is going to be fairly limited by Australia and Brazil's supplies, and then also tariffs could have more of an impact there as well on our ability to pull in those imports. So as we look, like I said, for this year, with the addition of the imports and then not much of a decline to production, we're actually on track to be up for per capita net beef consumption. But then as we do look ahead, those drops to production expected on forward aren't going to be able to be fully offset by imports. And so we do expect to see a decline in 2025 and then a larger drop probably in 2026. So that's kind of inevitable that we do see some tightness there, but probably not down to 2014-15 levels. Part of that being with more imports available now, and then part of that being, of course, the larger weights that we're seeing. If we look at the overall production for red meat and poultry, we're seeing that be larger this time than last. This is consumption rather than production, actually. I said that wrong. But we are looking at a lot larger supply in general. And even as we are going to see smaller beef consumption and availability, the competing meats with pork and poultry are going to stay pretty strong. And while that does act as a competitive factor to beef, it also does help create more of a healthy market still at the same time, because those proteins are available. They don't have to go up quite as much and squeeze the consumer as much. So this is actually a pretty strong sign for the overall level for beef, because we don't have to see the huge swings that we did see in the previous cycle. Okay, so moving into demand, and then we'll get into prices. So one thing that beef has been able to do here is really outpace the other proteins as we do look at demand. So you can see from a retail perspective, this is showing the retail percent price change going back to 2000 for all fresh beef versus the pork composite retail and the broiler composite retail. So beef has been able to keep a much stronger growth pace throughout the time. And that's really continued to be relevant this year in a big way. So beef has really been able to grow demand above the rate of inflation, is what we see there. This year hasn't been different. We're actually on pace to be record high in beef demand for this year. Demand is taking into account the prices and then the overall supply, and then putting it into an index. And these are inflation adjusted. So even with inflation, you can see that we're at a strong demand point. Prices have continued to move higher. We saw a pretty big jump this year, on track to be at about $8 a pound for this retail all fresh beef price. And next year, we do expect to see a lot slower of a growth there. And with the drop in supply, so even though we do expect prices to be a little bit higher, probably not enough of an increase there to be measurably stronger demand because of that drop to supply. So still, though, at a historically strong level, one of the top 5 years is what we're expecting next year. And so there's been no major cracks in the beef demand up to this point. Of course, that is a risk as the consumers are getting squeezed. Inflation has been tough on people. But up to this point, they always say the best measure of demand, or the best forecast of demand, is to look over your shoulder, because it's pretty tough to predict when we do see demand drop off. But up to this point, there's been no cracks. And beef has really been able to tell a positive story on the demand side by responding to consumer signals. So consumers have really responded to the improvement of quality and consistency for beef. And then producers in turn have also responded to those signals by producing more of that. So you can see up to this point, we're at over 80, almost 85% choice plus prime grading percentage. So that's compared to about 50, just over 50% in 2005 was grading this well. And so we do have a lot more of this high quality beef available. Part of that is also the feeding systems. On Feed for Longer does tend to allow them to grade better, but then a lot of that's genetics as well. So in general, the industry has really responded, and those signals are coming in the forms of premiums. So you can see this is at the wholesale level, the additional value of box beef by grade. So you can see this blue portion is the spread between the prime and the CAB product, and then CAB to choice is this yellow here, and then choice to select, that spread is this red. So you can see that all of those have really really grown in the last 10 years for sure. And then here in the last several, we are seeing a little bit of a decline, but part of that is that there's less select available. So if we've taken out of the supply, it's been from the select side. So it's not that the choice demand is worse, it's that there's a lack of that select. But and then the kind of same with prime. Prime availability has continued to grow with the percentages stronger. So even though it's not as strong as 2022 levels, it's still relatively elevated and still seeing good, consistent demand there. And as we look, that is getting passed back to the cattle, back to the fed cattle supply. So you can see that these are the premiums by grade versus the negotiated cash price for cattle. So this is more like the grid premiums that you might see that's based off of how cattle grade. So not as strong as what you see at the wholesale market. We're looking at $70 a head rather than $20 a hundredweight, but that's still a pretty strong premium for these higher choice cattle. And then there's actually even a discount here as you look at the select. And that's really driven off of the demand from the consumers, being that there's just a lot more demand for these choice and above cattle. So as we think about how much, before we get into cattle prices, we're going to look at this leverage here. So that's kind of the last component once you get through the supply and the demand is the leverage there. So how much of those dollars can the cattle producer capture? So you can see back in COVID, whenever packing capacity was very limited compared to the supply, we weren't really able to capture any leverage or very much of those dollars back to the cattle producers. But here now we are back in a very strong leverage position. 57, 58% is considered really strong. When we did the previous cattle cycle, when we did get back above 58, so we were at 58 to 59%, that's when we did tend to see the packing facilities really struggle, which did force them to shut down. And so that's where we lost some packing capacity, and then we lost some leverage here. So as we think about this helps show it pretty well. This red line is the weekly average fed slaughter, and then this blue is the estimated 40-hour capacity. This yellow here is just representing the extra loss that we had to the 40-hour capacity due to COVID. But in general, when this red is above, when we have more cattle available than what we have capacity, we do tend to see a lot less leverage. So you can see in 2012, really 2012 on forward, we did have that stronger leverage position. That's where we were at the 58 to 59%. But what happened? Several plants closed. This packing capacity supply continued lower. And then at the same time, we increased our cattle supply. And so then we got out of position there from a leverage perspective, where there were a lot more cattle available than what there were hooks. So now we've finally gotten back to the position where there are more hooks than cattle. And so you can see that that's really is what's helped us gain back that leverage. And as we move forward, we're actually hearing plants being built and being added. So if anything, capacity is on track to increase. Of course, there could still be closures like we did see the previous cycle, and due to the fact that there's going to be fewer cattle relative to capacity for quite some time. So that could force another packer out, but those are really hard to predict. And up to this point, if anything, it looks like capacity is going to grow within the next 5 years, even as this available fed slaughter declines. So that kind of gets us through the leverage, and then we can get into the prices. So as we look, as you can see, record highs, anyone? So we are moving into record high levels for pretty much all cattle throughout the system. So starting out, we're going to look at the fed cattle prices here. We're on track this year to average 186. Right now, that's around what we're at, but you can see that the price increases from here are a lot slower. So 2022, we were at 144. We were able to increase nearly $30 a hundredweight within a year. This year, we did see prices push over $10 higher, so another pretty large push there. But then future gains are going to be smaller. And as we look at this market this year, we've been pretty range bound and expect more of that in the next few years as well. Whenever we do start to see packers losing money and beef demand slowing, that's where we'll see them cut back on the kills, and then the fed cattle demand will kind of slow down a little bit there and keep prices from getting too out of whack and keep packers from losing too much money is what they're going to be looking to do. And as we look, the seasonal pattern the last couple of years for this fed steer values has been really different. So typically you tend to see the lows in this June through August time period where we generally would have the fewest cattle available. But the last couple of years, that's actually been where we see the market push. That is a time where we do see the strongest beef demand with all the grilling demand that we see there. So I think that's part of it. And then there hasn't been as many available in that time period just because we are feeding them longer. So the ones that used to get available maybe in June, July are more August, September now. And so that's been part of that change as well. So I think that seasonal pattern is going to be a little bit tougher to follow here in the next few years, as it does look like we're seeing a little bit of a shift to that. But generally still, as you can see, just more range bound. So as we look at what the futures have priced in, they're still at about, they're not at a huge range here, looking out on ahead. So in this year, even since February, really, we've been at this 180 to 195 range. So a lot tighter of a range, but still a generally higher level, which is what we expect next year as well. As we look, we've got a cattle on feed report coming out tomorrow. Now that report is going to look a little bit bearish at the surface. So we placed a lot of cattle here in October. So placements are going to be up compared to a year ago, despite the smaller calf crop and despite smaller available outside supplies that we would expect to be seeing. But part of that was a lot of drought forced movement. So we were extremely dry there in October. There were a lot of cattle placed. We're already seeing that slow down here in November. And then again, even though the cattle on feed number is going to be strong, because of those strong placements, those cattle aren't going to be available till April at the soonest, but a lot of them were getting placed against May, June, and on out because they're light weight placements, and the incentive has been to add feed. So this next report that comes out tomorrow, we're expecting it to be pretty high. And then another part of this cattle on feed is that as we do feed cattle for longer, this will stay generally more elevated, even if there's a tighter front end supply, or if we say we're fairly current. we just will generally have a pretty strong cattle on feed number, partially because more days on feed here. And as I said, we are still looking at a smaller feeder cattle and calf supply. So those supplies are extremely tight here. They were going into this year, and then even as we look into next, looking pretty tight. This is adjusted some to add in those cattle that are added from the dairy influence side. So less veal calves, and that component does add this and keep this number a little bit stronger than what we saw in 2014 and 15. And then also fewer replacement heifers getting rushed back into the system compared to that previous cycle that you can see there. But even still, at pretty tight numbers and expecting those to continue to tighten up as we look at next year, which is supportive for this feeder cattle market. You can see prices have stayed pretty elevated this year. I mean, we do still see these moves. And as we think about this futures market, it's really been driven off of the corn prices and then the deferred live cattle futures. So the live cattle futures, the back end has finally started to gain some traction. And so we are seeing a little bit more of this feeder cattle move to the market as well. And so when we do start to see that optimism priced in for the fed cattle and then for the feeder cattle, that is typically a good time to consider some risk management strategies, because you can see how big these prices or how much these prices can swing. And the other component there is going to be corn. So going into this next crop year, like I said, we expect pretty comfortable positions, but if we are heading back to that drought pattern, that could limit corn supply, or the futures could take that as a concerning factor. And if the corn futures were to run up, that would negatively impact feeders without necessarily impacting those live cattle. So risk management here is going to be important, because even though they're going to be generally elevated, there can be a lot of moves within that. And so doing something such as LRP could just help you manage a lot of that risk that we might see with the markets here. Looking at the calf prices, generally elevated, but still following a seasonal pattern. October, as we did get extremely dry, we didn't see really much moisture in a lot of the cattle country from August on through October. That did weigh down the calf prices here, but even still, we're on track to average $310 a hundredweight this year. That's up about $50 a hundredweight there as you look compared to last year. And so the big gains for the calf prices are probably already behind us at this point, but we do expect continued strength next year as well. So just a smaller gain as we do consider the difference between this year and next, but still generally elevated. And that's coming from the stronger fed prices, feeder, and then getting passed back to this cow-calf producer for these calf prices. I'm going to skip to this part first. So like I said, the big increases that we see in the cycle are already behind us probably. So as we look, this is the 2024 level. But even still, prices should remain elevated and generally increasing as we do look at the next few years on ahead. And this is for the cutout, so the wholesale beef cutout. And then that gets passed back down to the fed market, especially as we do gain leverage there, so a higher percentage of that, and then back down to the feeder cattle prices and then the calves. So generally, we've already seen the big moves, but still going to remain elevated as we do get into continuing tighter supplies on ahead. And then as we look, the bred female prices have also reached record levels. And they've even surpassed the fed cattle value. So this chart here is looking at the average bred cow price versus the fed cattle value. So taking the weight into account here as we do look at that fed cattle value. But even still, we have seen this bred cow value exceed the value for the fed cattle. So when we do see that, that's a pretty strong expansion signal. Last cycle, it didn't even get above, but it did get about even to it. So there's definitely value to the fed cattle or to the bred cattle. And so a lot of that is driven off of the strong calf values that we're seeing and then expecting to see as we move through the next few years. Looking at the cull cow market, that's where we did. So this is the utility cow price or the cull cow price. We've already seen the big gain here as well. You can see we're up nearly $20 last year, up about another $15 this year. Expecting to be a little bit stronger next year, but maybe not a huge move from there. So what this chart that I skipped past was showing was this 90% lean beef price. So this is the lean trim market. You can see that this is a lot of what's driving. This is a really similar pattern to what we see in that that cull cow market, and this is what's driving that is this value for the 90s lean beef. Now, what's limiting to this for further upside is, for one, we're already at extremely stretched values here. So nearly, already above this 350 hundredweight. So that's going to be limiting in itself in this record high level, but then also that we're able to import lean beef as well. And if it gets too elevated, we'll be able to import it for less than what we would have here if it got above that really much above this 380 level. So that's another thing that's going to keep a little bit of a lid on this market, even as we do get to extremely tight whole cow availability levels throughout the next few years, really. But even still, these prices will be elevated, but just further upside is going to be a little bit limited there. Looking at the industry as a whole, you can see that there's just been a lot more money coming back into the system. So if we look, this chart's a good one to kind of look big picture. Throughout the 80s and 90s, there was not a lot of consumer focus, so there wasn't a lot of growth to that higher quality beef. And so there wasn't a lot of profitability going back to cattle producers. Here from the 2000s, really, we saw demand growth at work. That's where we did start to see more of that choice and higher production. And then here in the past 10 years, really, we've seen a lot more of that. So again, we're at over 80% choice and prime. And that's just putting a lot more money back into the system. And here, as we move forward, we are getting into this tighter calf supply. So that's really allowing more of these calf producers to capture that, and then also the stockers as well. And less of that is even getting back to the fed cattle because of these strong values and tight availability. But there is a pretty big difference as we do look at the cow-calf producers. So, here in these kinds of years, there's the low return producers, the high return producers, and then the average is what the bars are representing. So you can see right now, everyone is making money, but in the tougher times, so back in 2015 to 2022 maybe, this is for the cow-calf producer, those were tougher times and generally lower profits, but there was still profitability to be had for these high return producers. So what do these focus on? They really focus on animal health, nutrition, and genetics. So maximizing what they're getting out of their cattle. These are the cattle that are going to perform well as far as the grading. So then they perform well on the grid, and those premiums do tend to get passed back down. Some management decisions that could help with profitability are looking at winter grazing programs. So keeping that 550-pound calf and then grazing them all winter and then selling them the next year. You can see more years than not that has paid off. Exceptions here being that 2013 to 14 and then 15 to 16 where we did see the market turn in a hurry. Again, we're not expecting that this year, but still we might not see these level of profits here because of those stronger calf prices that we're seeing. And then the summer grazing program does still tend to see some profitability as we look over time, But there are years where that's pretty low. A lot of those are going to be the drier years where it does just cost more to keep those cattle. So it's important to consider, of course, if you sell the feeder cattle versus that calf, it's going to bring more money. So this bar is just looking at the difference in dollars per head. But it's important to consider what it's costing you to put that money or to put those pounds on them. And so considering the break-even cost of gain here. So if we're making this average of $281 a head, that's for a 300 pounds added and selling them in October versus selling in February. But that's a 94-cent a pound break even. So if you're able to add those pounds for less than that, then this is going to be a profitable thing. But in years where feed's more expensive or it costs more to do that, then that's a little bit different of a situation there. And then other things, as we look at the high return producers versus low return, high return producers do generally capture a larger percentage of their calf crop. So this is live calf crop compared to the cow's bred. So of course it makes sense that if they have more calves to wean and sell, they do generally fall into this high return producer. Another thing is the genetics. So of course this blue line or this blue bar here is 2023. So all values are more elevated there, but you can see that the higher value bulls do tend to lead to higher value calf prices. So all of this data is coming from our cow calf survey that we send out at the beginning of the year. So we don't have 2024 available yet, but it does generally show that whenever you do invest a little bit more into the genetics, the calves do tend to bring more money there as well. And then another thing that we do tend to notice with these high return producers is that they tend to weight and wean them at a little bit heavier of a weights. So this is just looking at the average weaning weights sorted by the return and then sorted by the sex, so steers and heifers. So generally they do wean them at a little bit larger weights there as well. So that's what I've got for you. Do you have any questions that I can answer? Micah, I think you had a couple that you'd mentioned.
Hey, Mary, yes, thank you so much for kind of going through all that. I think it was really great information. A couple of the questions that were submitted ahead of time, I feel like you've hit, but I do want to kind of circle back to them just to provide some clarity and also maybe give you an opportunity to elaborate if that's okay. So right off the bat, you talked a little bit about the weather and expectations on feed prices. What are your expectations for feed prices and specifically the hay market over the next year?
Yeah, so the hay market and feed prices, like I said earlier, those have come down a lot from what we saw in 2022 and 2023. But we do expect that they're not going to get a lot lower from here. And if anything, there is some upward risk there. So it wouldn't be a bad idea to secure some of that because prices probably aren't going to get a lot lower because we are moving back into a dry pattern. So I'm optimistic there, but cautiously optimistic because we are seeing drought already start to spread.
It depends, right? As
Yep.
every economist would say. I want to talk next about your graphs when it came to retaining heifers. Are you seeing any indication producers are beginning to retain heifers, and do you think that trend is going to continue?
Yeah, so we are seeing some indications. We do see a little bit smaller of a percent of heifers showing up in the sales data, so the auction data. A few more heifers are being sent, and so that tells us that there's probably some retention there. And then we are seeing a little bit smaller of a heifers as a percent of the cattle on feed, so we do get some numbers there. And so they are starting to be placed a little bit less as well. But like I said, we're not going to retain in a huge way. It's not going to be a huge swing that we see there. But yeah, there are some retention, some heifers being retained in areas.
One of the things you talked about is the is that although things are looking pretty positive, risk mitigation is still pretty important. And so one of the questions that was submitted in are your favorite methods for risk protection on finishing cattle?
Yeah, so there's a few different things there. Part of that is going to be um, locking in some prices if you do see the market take a run, but there hasn't been as much opportunity lately here in the fed cattle market to um, lock in a larger back end or deferred price. But some of that's going to be locking in your feeder prices. So at a time where when you do see the market move a lot lower, you might lock in a buy there. But using LRP then, if you're selling feeder calves, that's a method to protect risk. Another one would be securing those corn or grain values. So locking in that price, not only in the futures, but also you could lock in basis ahead of time potentially if you have a local grain elevator. And then, yeah, just looking to take advantage of LRP, which is a subsidized way kind of to protect some risk.
And of course, we've got Austin on our team here at Farm Credit Mid-America that would love to talk to any of y'all about livestock revenue protection and how that can be kind of a benefit to your operation. So if that's something you do want to learn more about, feel free to send me a note, and Austin would be happy to connect with you on how to employ that risk mitigation on your farm. I've got two more to close this out here, Mary, and that's one that was submitted. And your thoughts, is the cattle cycle still relevant?
Yeah, so that's a good question because, I mean, especially as we consider that last cycle, this cycle is looking a lot different than the previous cattle cycle. And though, I mean, we do expect some expansion, but not in a huge way. And then the prices aren't swinging nearly as extremely as we saw in the previous cycle. But I do think that it's still generally relevant because as we do look to retain heifers and we do look to expand, there will be some anticipation from that as we do consider, or as market participants of futures look at those fed cattle values. So we will see them move lower then again as we do get into larger supplies, which of course isn't expected for several years. But yeah, it does still have a cyclical pattern, but not to nearly as extreme of levels whenever you're not increasing like we saw last time. So yes, but less of a cycle than what, or less of an extreme cycle than the previous one for sure.
Fair enough. This one just came in, Mary, and I think it's an interesting question that I'm curious if y'all are thinking about. It says, with the new administration coming in, what kinds of changes should we expect as far as beef production with packaging plant restrictions? Are you all have anything coming up on the radar as far as packaging plant restrictions go with the Trump administration?
There's a lot of things there with that question. That's a good question. Um, but at this point, we don't expect there to be a huge impact. One thing about this administration is they do continue to tout that they want fewer restrictions from the government. So um, I don't expect them to really be micromanaging the markets. We hope that they kind of stay out of it because the markets work in general. And that just kind of says that, you know, packers will lose money at times, but then they will cut kills because of that. And but that does tend to support beef prices then, which does just get passed back down. So generally, we're not hearing of a ton of restrictions coming on, but that is something to be watching. You hear about like McDonald's lawsuit against Packers as well for whenever they're cutting kills and they say they're controlling the market, but really, I mean, it's more of a supply factor. But that is something important. That's something we'll be watching. So in future webinars, I might have a better answer there as we do kind of see what happens once this administration is in place. But up to this point, not expecting a lot of restrictions to change things there.
And to close us out, just kind of a simple question. Overall on the cattle market, are you bullish or bearish?
Overall bullish. You saw my price chart. That cattle prices are generally increasing, so overall bullish, but again, with some caution around weather and then big market swings that we can see within that.
Well, thank you so much for joining us, Mary, and we appreciate all the customers and team members that are on the call. As Mary alluded to, our next scheduled webinar, specifically with CattleFax, is going to be Wednesday, March 26th. And so if you are curious about how CattleFax's thoughts have changed through kind of this holiday season and then into the spring, we'd encourage you to join us back on March 26th. Keep a watch out for that invite into your email inbox as we get closer to that date. But we hope you all have a happy Thanksgiving, and thank you all so much for joining us.
Yes, thank you all for your time. Thanks, Micah.